All right. Good morning, all you magnificent melon heads. I hope you guys are well. Today is Wednesday, March 13th, 2024. And the top story this morning is the ARM IPO. The lockup period has come and gone. It is now free and clear for Softbank to unload shares if and when they choose to. Now, ARM IPO'd last year. It was one of the big AI darling stocks. The stock has had a rip your face off rally along with anybody else who even sneezed and it sounded like AI. ARM Holdings is up 149% since its IPO. And Softbank, a Japanese venture fund, it's not a bank. They're like pretty much like a private equity fund. Softbank owns 90% of the shares in ARM Holdings. And they're allowed to sell them now anytime they want. So basically, the price of ARM Holdings is now determined by SoftBank and what they decide to do. Now, that came and went yesterday. The stock did not sell off massively, so it's not an instant dumping of shares, but it could happen at any moment. That's an important one to keep an eye on. This company has rallied just along with the whole AI mania. It's just gone up well beyond any fundamentals, beyond any mathematics. It's really just an emotionally driven stock now. And the funny thing about manias is there's no telling how high they can go because they're not limited by things like math and value and dollars. So it could go another 100% higher from here, or it could crash as soon as the opening bell rings. Nobody knows. We'll see where that one goes. We've also got Tesla. The bursting of the EV bubble is continuing this morning. Tesla caught another downgrade, this time from Wells Fargo, who lowered their price target from $200 all the way down to $125. That's representing a 30% downside risk from where we're at today. Wells Fargo is saying that they don't think the price cuts that Tesla has offered are going to be enough to keep those vehicle delivery volumes up. And they're actually worried about the economics of the Model 2, the new compact that Tesla is coming out with. So things for EVs just continue to get worse. Toyota just gave their workers a big raise. A lot of Japanese car makers and even Nippon Steel just came out with a big raise recently. So wages are rising for blue-collar workers in Japan. That's a big one because the Bank of Japan has been sitting there at negative interest rates for years, waiting for what they call a virtuous cycle of inflation where prices rise, causing wages to rise. And then because the wages rise, people spend more. And supposedly in this Keynesian paradise, everybody's supposed to get a better quality of life. Well, we've already had the cost of living going up. They haven't quite had the wages happen yet. Well, that's finally starting to happen. And, well, the Bank of Japan could depart from negative interest rates as early as next week when they get together and decide to debate that negative interest rate policy. A lot of people are paying close attention to that yen carry trade where you can borrow cheaply in Japan, get those yen, convert them over to dollars, and then come into the States and buy your favorite AI darling stocks with money that you've essentially borrowed at negative rates in Japan. Well, we'll see how that one works out if and when Japan finally raises rates. Got a big spike in mortgage applications this morning. That one came up. Applications were up 7.1% for the week ending March 8th. Modest increase in the 30-year mortgage applications. That was up by about 4.7%. The 30-year mortgage rate dipped 18 basis points. That was really what was driving that. But once again, we got a big spike in refis. People are refinancing their mortgages into higher interest rates. That is scary in this environment. That's people who can't pay their bills, and so they're using their homes as an ATM to try to keep things going a little longer. We've seen this play out before, and it never ends well. And also talking about people having trouble paying their bills, not a lot of money to spend at the end of the month. A couple of important ones. We had Adidas swung to a loss for the first time in 30 years. The German apparel manufacturer posted a lousy quarter. Now their Yeezy sneaker line has been causing problems for them. But they saw a 21% decline just in the fourth quarter in North American sales. That is, American consumers are out of cash. And I guess even credit cards and buy now, pay later has not been enough to keep Adidas sales up. We also had Dollar Tree came out with earnings that missed expectations. And they announced that over the next few years, they will be closing as many as 970 stores in the United States. That is tens of thousands of jobs that are going to be going away, low-paying retail jobs, but still jobs, as nearly 1,000 of these Dollar Tree, Family Dollar. They own a couple of those discount lines. But that's a lot of stores closing. A lot of stores closing in a very short time. And they're also starting to talk about the Fed ending QT. Look, the Fed, they just started QT. I mean, I get it. They've been doing it since March of last year. But if you actually look at the Fed's balance sheet, they haven't really reduced their balance sheet by all that much. What, about $1.5 trillion they've unwound after adding almost $7 trillion to the balance sheet? We still haven't even gotten down to the level we were at from that initial COVID surge in early 2020. We've really just unwound all the additional quantitative easing that the Fed did all through 2021 when they left the money printer on for way too long. So they're really just starting to scratch the surface on the Fed's balance sheet. It's nowhere near where it was before this whole mess started, and they're already talking about ending it. And of course, once they end it, then the talk starts about when are they going to start it up again. And if you've been paying attention to the commercial real estate market, you probably think that is going to be pretty soon. So there's a lot happening in the world today. Why don't we shrink my big million of a head and let's start seeing what's going on in the market. And guys, while we're doing that, don't forget that like button. It really helps with the YouTube algorithm. And if you're new here, hit the subscribe button and the notification bell right next to it and have your coffee with the Melon Heads as we do this every day. The S&P 500 is essentially unchanged at the moment. It's down 0.4 points or 0.01% lower. So no move in the S&P. We've got the Dow is a little bit higher this morning, though, 45 points to the upside or 0.12% up. And the NASDAQ is in the red, down 45 points or about 0.25% lower. So not a lot happening in stocks this morning. We've got the DXY is modestly lower at 102.9. That's down 6 basis points. Not a lot of movement in the dollar either. And interest rates are higher in the long end of the curve this morning. We got the 30-year Treasury, 4.346%. That's up 3.5 basis points. The 10-year is at 4.184. That's up 3 basis points also. The 2-year, 4.611, up a point and change. And the 1 month is at 5.381, pretty much where it was yesterday. Looking over at the commodities board, we've got gold is doing all right this morning. April gold futures are up $2 at $2,168, about 0.1% higher. May silver futures at 24.57. That's up about 18 cents or about 0.75% higher this morning. Platinum is up about 0.2%. Palladium is up 2% at 1,073 for June palladium futures. So the PGM metals are having a pretty good run here. And crude oil is up 2% this morning at April WTI futures trading at 79.28. That's up $1.70. So that inflation read that we got yesterday was bullish oil prices and economy reaccelerating, inflation reaccelerating. I guess people are going to be burning more oil, or so that is how the reasoning goes. And Bitcoin is on the move again this morning, up another $1,500, 73,000 for Bitcoin, another all-time high. Look, we've got the whales are dumping and we've got the ETFs are buying. And right now, the ETFs buying is overwhelming the whales dumping. And so the price is moving higher. And, you know, case in point, check out this chart. Again, shout out to Zero Hedge, who's been putting this chart out on a regular basis. Yesterday was the biggest ever as far as inflows into ETFs. Now, we didn't get a lot of big price movement yesterday because, again, the Bitcoin whales were dumping, selling into that ETF enthusiasm, cashing out. So you do have, you know, two very powerful trends going on right now. But, you know, this is over $1 billion flowed into Bitcoin ETFs yesterday. The BlackRock ETF alone had 848 million flow into it. That is a lot of buying pressure on Bitcoin. The ETFs take that money inflow and they have to go into the open market and buy the Bitcoin. The whales are selling it, but the whales aren't selling enough in order to keep that from happening. And, you know, we've seen the psychology of a Bitcoin rally in the past before, and it looks like it's starting early this time. Once the FOMO takes over, Bitcoiners just start piling in, and it doesn't usually stop until 18 months after the halving, and the halving hasn't even happened yet. So this run in Bitcoin, it's going to go for a while, guys. Understand there's still risks out there. There's no shortage of con artists and frauds in the crypto space. Tether is always a risk. Tether could go at any moment. Those things notwithstanding, though, Bitcoin is in for a wild ride here. That is continuing today at 73,000. Now, here's the big one that's on my radar this morning is ARM Holdings. ARM traders brace for a sell-off as the lockup lifts after rally. Softbank gets their first chance to cash in after the September debut. The stock has had a 149% rally since the IPO. This thing is just running like the blazes. ARM Holdings PLC has more than doubled from a September debut on excitement about demand for semiconductors used in artificial intelligence computing. That's made the stock tempting for insiders to sell, with a lockup expiring on Tuesday. Most public offerings are accompanied by a 6-month lockup period that prohibits insiders from selling their holdings. That limits the float, or the quantity of shares available to trade, which can make for big swings in the price of a stock such as Softbank Group-backed chip designer, which has one of the loftiest valuations at more than 33 times projected sales. And that is obscene. Not 33 times earnings. That is 33 times sales. And again, you have to understand this, guys. If ARM Holdings had no payroll, if everybody was working for free, if they had no bills, if there was no electric, no lights to keep on, no nothing, if they had no cost of doing business whatsoever, if every penny this company took in was pure profit, it would still take 33 years for that company to break even on what its stock is currently trading at. That is an obscenely high valuation. And if you're SoftBank and you're sitting on 90% of the shares of this company that are up over 149% in 6 months, well, that's a pretty tempting sale, isn't it? ARM fell as much as 4.2% on Tuesday before erasing the losses on trading volume that was elevated compared to last month. The stock was little changed in New York at 11:38 yesterday. The big wild card is what SoftBank plans to do with its more than 900 million ARM shares. The Japanese conglomerate owns 90% of the chip company, giving it a massive influence over the stock. SoftBank, which has gained nearly 30% in Tokyo since ARM's debut, dodged a question about what it plans to do with its stake on a February earnings call. That means dump on retail investors, by the way. Instead, they reiterated that ARM is the most important company in its group. SoftBank can utilize ARM assets in different ways, including as collateral for a margin loan. Oh, that'll end well. No, we're just going to borrow against those shares that are trading at 33 times sales. Who wants to give them that loan? The firm's finance chief, Yoshimitsu Goto, said on the company's most recent quarterly call. Good God, borrowing money against shares that are up 149% in 6 months and that are trading at 33 times sales. What's the worst thing that could happen? Don't answer that. ARM Holdings down 1.16% ahead of the opening bell, trading at $128, still well up from their IPO price. And also going on today, something I've been warning about for a while, EV euphoria is dead. Automakers trumpet consumer choice for U.S. car shoppers. This one was posted this morning on CNBC. The buzz around electric vehicles is wearing off. You think? For years, the automotive industry has been in a state of EV euphoria. Automakers trotted out optimistic sales forecasts for electric models and announced ambitious targets for EV growth. Wall Street boosted valuations for legacy automakers and startup entrants alike based in part on their visions for an EV future. But now the hype is dwindling. Pay attention, AI bros, because this is the same thing that happened to EVs. Now the hype is dwindling and companies are again cheering for consumer choice. Automakers from Ford and General Motors to Mercedes-Benz and Volkswagen, Jaguar, Land Rover, and Aston Martin are all scaling back or delaying their EV plans. Even U.S. EV leader Tesla, which is estimated to have accounted for 55% of EV sales in the country in 2023, is bracing for what may be a notably lower rate of growth. That's according to CEO Elon Musk. The broad return to a more mixed offering of vehicles with lineups of gas-powered vehicles alongside hybrids and fully electric options still assumes an all-electric future eventually, but at a much slower pace of adoption than previously expected. So EV sales are still growing, but this idea that, by 2030, all cars are going to be electric, it's just not happening, guys. And, well, the bad news for Tesla keeps piling up. This one in Investors Business Daily this morning, Tesla stock is downgraded with vehicle deliveries to disappoint. This Tesla bull is still optimistic, according to this IBD article. By the way, I am not a Tesla bull by any measure. Tesla stock was handed a downgrade early Wednesday on expectations of disappointing first quarter deliveries, vehicle price cuts, and pessimism around the market for the EV giant's long-awaited next-generation offering. Wells Fargo downgraded Tesla to underweight, down from equal weight Wednesday with a price target of 125, which is down from its current price target of 200. The firm's underweight rating is equivalent to a sell rating, and its price cut represents a 30% downside risk to current Tesla levels. Wells Fargo expects Tesla unit volumes to disappoint as price cuts, with its view that the vehicle price cuts are having a diminishing impact on demand. The firm also wrote Wednesday that it believes that the economics of Tesla's next-gen vehicle, widely known as the Model 2, are likely tough as a mass-market compact vehicle. So Tesla's lowering their prices. Wells Fargo saying it doesn't matter. That's not enough to get people to buy these things. And they think this compact Model 2 is going to be a dud. It's just not going to be a mass-market vehicle. And Tesla stock is down again this morning, 2.1% lower, trading at 173. Again, the price target from Wells Fargo was 125. So 30% downside risk, according to Wells Fargo. But it's not all bad news in the automotive space. Toyota agrees to wage hikes and bolsters BOJ policy shift view. This is what the BOJ has been waiting for. The Bank of Japan wants wages to start rising so that they can start raising interest rates above zero, because the whole world has been raising rates for the better part of a year and a half now, but Japan still has their rates in negative territory. And these wage hikes from Toyota and other automakers could be giving them the breathing room they need. Toyota Motor Corp met its labor union's demands for increases in salary and bonuses in full for the fourth straight year, and another sign that a sustainable wage price cycle may be taking hold in Japan's economy as the central bank considers the timing of a long-awaited interest rate hike. The yen rose and government bond futures fell. Signs traders were adding to bets on an imminent move by the Bank of Japan after early reports that the world's largest car maker reached agreement with its unions on Wednesday. Although the union didn't disclose exact figures for the wage hike and bonus, Toyota Chief Resources Officer Takanori Azuma said they were at the highest ever level. So we got a big raise for Toyota. We've had Mazda. A lot of the other Japanese automakers have announced big raises. We had Nippon Steel just announced a big raise recently. So the big wage hikes, they are coming in Japan. They're long overdue. They're nowhere near what the inflation has done to them over the last few years, but the wages are nonetheless rising. Bank of Japan is going to see that and say, maybe it's okay for us to start raising rates, which of course would put the kibosh on any future wage increases, but that is what the Bank of Japan has been trying to do. Good luck with that one. And mortgage applications are on the rise in the U.S. Mortgage apps in the U.S. increased by 7.1% in the week ending March 8th, easing from a 9.7% rise in the previous period, but still a pretty big jump. That's according to data from the Mortgage Bankers Association. Applications to buy a home advanced 4.7%, and those to refinance a home jumped 12.2%. Those refis really scare me, guys. People refining their house, they're doing cash out refis into higher interest rates. They're behind on their bills. They're in credit card debt. And so, yeah, it does make sense because you're paying off that 25% interest rate on your credit card by taking out, say, I don't know, refining your home into a 7% mortgage or a 6.75% mortgage. But still, using your house as an ATM at these all-time high valuations when unemployment is on the rise, when debt spending is on the rise, this is a very dangerous phenomenon that's going on here. Refi applications jumping 12.2% in a week. That is an alarming trend. Meanwhile, the average contract interest rate for a 30-year fixed-rate mortgage with conforming loan balances decreased 18 basis points to 6.84%. That's the lowest in 5 weeks. Mortgage rates dropped below 7% last week for most loan types because of incoming economic data showing a weaker service sector and a less robust jobs market, with an increase in the unemployment rate and downward revisions to job growth in prior months. So we're seeing lower interest rates because the jobs market is not as strong as they've been telling us. That jobs report last week was really bad. Those downward revisions were terrible. Big jump in unemployment. And so now people are refinancing, cash out refining their home right before they lose their job. I'm sure that's going to end really well. Dollar Tree misses on earnings plans to close 600 Family Dollar stores in 2024. Yikes. 600 stores just this year. They're going to close another 370. They're planning to close in 2025. Bad news from Dollar Tree this morning. Shares of Dollar Tree took a dive Wednesday after the discount retailer missed fiscal fourth quarter profit expectations, provided a downbeat outlook, and said it planned to close a significant number of Family Dollar stores. The plan to close stores follows a review initiated during the fourth quarter, which evaluated market conditions and individual store performances. The company expects to close 600 Family Dollar stores in the first half of 2024, and another 370 Family Dollar stores and 30 Dollar Tree stores are expected to close over the next several years. Add that all up, you've got 1,000 stores closing from this company over the next few years. That is a lot of jobs that are going away. See earlier comment about all the cash out refis. and the weaker labor market, 1,000 stores closing. I don't know how many people work at the average Family Dollar, but it's a good bet. It's at least 10, probably 10 to 50 people working at the average store here. So really bad news for those employees. Same-store sales or sales of stores open at least a year did rise 3% to beat expectations for 2.8% growth. All right, so that's right in line with inflation, not really a beat or not really any kind of news there. That means they're just treading water. There was a 4.6% increase in foot traffic in the store, but that was offset by a 1.5% decline in the average ticket. Dollar Tree same-store sales were up 6.3%. That's actually a pretty good number, while Family Dollar stores were down 1.2%. And with inflation at 3.3%, down 1.2%, that's actually really bad. So all those store closures, that earnings miss, we're looking at Dollar Tree shares are currently down 13.25% ahead of the opening bell, trading at $129.68, down $20 before the open. Really bad news for Dollar Tree this morning. And more bad news for the American consumer. Adidas posts the first loss in 30 years and warns on the U.S. First loss in 30 years. That means even during the GFC, Adidas didn't swing to a loss. That goes to show you how troubled the American consumer is right now. German sportswear giant Adidas posted its first annual loss in more than 30 years on Wednesday and warned sales in North America would fall again as sportswear retailers in the U.S. struggle with high inventories. We've seen that. We've seen the inventories. They've been working down, selling down their inventory for the better part of a year now. We've seen lousy numbers from all the manufacturing PMIs. All the factories have been saying, yep, the inventory, they're selling it down. We expect that inventory drawdown to end any day now, and then those new orders will start coming in from the factory. Well, it hasn't happened yet. Those orders are not coming in. The trucks, the boats, there's less stuff moving. And, well, the sales are down. Adidas posting a loss for the first time in 30 years. That just goes to show you that this inventory drawdown, it's not over yet. It's still continuing. Adidas has been battling to right itself after it cut ties with Kanye West in October of 2022, suspending sales of the highly profitable Yeezy sneaker line. And look at these numbers here. Lower demand and overstocked stores in the U.S. have weighed on sportswear and apparel companies. Adidas said sales in North America fell by 21%. That's just in the fourth quarter, guys. That's quarter over quarter, a 21% decline in sales for Adidas. They also fell 16% year over year. So lousy numbers for Adidas here. And this is apparel, guys. This is not, this isn't chips. This isn't EV. This isn't like some big hip electronics product that sells a lot and then enthusiasm dies and it's cyclical. This is clothes. This is stuff that's generally pretty constant demand. This is a direct line to the health of the American consumer. And as you can see, Adidas, their North American sales down 21%. And that's even as Americans continue to run up their credit card debt. Like, let's take a look at this one. Consumer credit in the U.S., $1.052 billion. Look at what this credit card debt continues to do. It keeps rising. And still, Adidas is swinging to a loss for the first time in 30 years. And this chart doesn't even capture the buy now, pay later loans that people are using. So the American consumer is in really bad shape here. Inflation has just killed them. They're spending everything they have on rent, food, and utilities. There's just nothing left for Adidas clothes at the end of the month. And last but not least, well, let's look at Adidas stock real quick. Adidas stock is actually up right now. It's up about 36 cents. This is priced in euros, trading at 193 euros and 10 cents. So Adidas stock, all things considering, is doing pretty well in this environment here. Now, the last one here, the Fed will slow QT, and what matters is where it stops. Oh, quantitative tightening, we barely knew you. You just got here, and already we're talking about you leaving. Good God, with interest rate cuts off the table for now, thanks to CPI, the U.S. Federal Reserve will focus on a different topic at next week's policy meeting, when and how to slow quantitative tightening. The process of reducing the vast securities portfolio amassed in previous efforts to support economic activity. A final plan should be in place by the middle of this year. Whatever happens, the destination matters a lot more than the speed. So what they're saying here is a final plan should be in place by the middle of this year, which means by June, they're going to be talking about ending QT, or at least starting to slow it, or at least talking about starting to slow it. But if you look at this chart here, this is the Fed's assets, the Fed balance sheet. you can see this drawdown, it's already started to level off and flatten a little bit. Let's zoom in here. Let's go to about here since the end of 2019. Look, guys, they barely started their QT, right? We went into the pandemic with about $4.1 trillion on the Fed's balance sheet. That number lurched higher to $7.1 trillion with the initial wave of COVID hysteria. But then they kept the money printers on. A couple trillion more got printed. It ended just below $9 trillion. And now here we are at 7.5, and we're already talking about ending QT. We haven't even gotten back to the level of this initial COVID spike. We're still a few hundred billion above that. They're already talking about ending this. And of course, as soon as they're done ending QT, they're right away going to start talking about starting up QE again, which means this endless expansion of the Fed's balance sheet. Like, zoom out on this chart. I guess their plan is to just continue this forever, guys. That's what they're telling us. The Fed is just, every time things get bad, they're going to turn on the money printers. They're going to buy up all that toxic sludge in the financial system. Then, they'll let inflation run rampant. As soon as life gets more expensive, they'll start QT. They'll reduce a token amount from their balance sheet like they've done these last two times here. Here was the QT they did in 2017 and 18. Here's the QT they're doing now. But again, they always settle at a higher level and then rinse, repeat. The next cycle, it starts rising again. Federal Reserve is just out of control. How about not printing money to solve our financial problems? What a concept. What if we just let the economic system right itself? I just throw them out there. You guys do what you want with them. And I want to say thank you very much to Mr. Evan Francis. Says, keeping an eye on the Fed's secondary credit. We're starting to get little jumps in that before primary credit is used. The shot will hit the fan. Look, the Fed has any number of ways that they can expand the money supply, right? They can expand credit. They can use this program over here, or you could tap the discount window or the bank term funding program that just went away. Secondary credit, primary credit. Then there's also federal home loan banks. And then commercial banks are always expanding the money supply when they issue credit too. So, no matter what happens, it's not just the Fed doing QE or QT affecting the money supply. We actually have a growing money supply right now as we speak. Even though the Fed is still engaged in QT and interest rates are still high, the money supply is still growing. That started happening right around March of last year. And lo and behold, we've got inflation is starting to surge again. These two things, it's not a coincidence that this is happening. That's how it works. When the money supply expands, prices go up. People shouldn't be surprised by this. And yet every time things get bad, venture capitalists in California are at risk of losing money. Quick, create some new program to pump hundreds of billions of dollars into the system, claim it's for the average person's well-being, and then act surprised when years later prices start going up again. No, we knew this was going to happen. Every time they do this, they tell us it's for our own good. They know it's screwing us over to help their rich buddies. They do the same thing every time. Shouldn't be surprised by it. And, well, it's going to get worse before it gets better. I thought this time around, the inflation we saw in 2022, people had finally wised up and finally realized that there is no free money from the government. Whenever the government prints money and sends you stimmies, it always means they're stealing from you, not giving you anything. And yet here we are talking about ending QT already, and we're already talking about secondary credit being used. So I guess we still haven't learned our lessons. There's still a large percentage of the population thinks money printing is how you get economic prosperity. So good luck with that, everybody. Tried to warn you. That's all I can do. Thanks again, Evan Francis. I appreciate the super chat. Support of the channel, sir. And thank you, everybody, for having your coffee with the Melonheads this morning. I appreciate that very much. Thank you to all my magnanimous Melonhead channel members and Patreon supporters. Appreciate everything you guys do for the channel. Looking forward to talking to you guys at 2 p.m. Eastern time today for our weekly Zoom get-together. Links to all that good stuff down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Until next time, everybody, live small and dream big.